So the next part under fixed installment method is purchase and sale of assets on different dates. Okay students, so question number 8 is related to this, so we solve this question. On 1st January 2011, a company purchased a plant for rupees 20,000. On 1st July in the same year, it is purchased additional plant worth rupees 8,000 and spent rupees 2,000 on its erection. So on 1st July 2012, on the next year, the plant purchased on 1st January 2011 having become obsolete and sold off for rupees 12,500. So on 1st October 2013, fresh plant was purchased for rupees 28,000 and on the same date the plant purchased on 1st July 2011 was sold at rupees 6,000. Depreciation is provided at 10%. On 31st December every year we have to prepare the plant account for from 2011 to 2013. So let's solve this sum. So first of all we have to prepare the ledger of plant account or plant ledger. So on the head I am writing plant account. Okay, so now students, year 2011. So in this year, January 1st we write the date. So on January 1st, asset is purchased. Asset means plant. Plant is purchased. So when plant is purchased, the journal entries plant account debit to cash account. So we debit the plant account by writing to cash account. Amount is 20,000. So in the same year, new plant purchased on July 1st. New plant is purchased on July 1st for 8,000 and erection charges on this plant is purchased. Erection charges is also paid, so erection charges is paid for 2,000. So as I told you earlier that when installation charges, erection charges are paid on the new machinery, so it must be added in the cost of the assets. So I'm writing here, so whenever new installation charges are paid, we debit the asset account, no different account is prepared. Okay, so now we will provide the depreciation on these two assets. Okay, so I prepare a working note, so it will be more understandable to you that how to calculate the depreciation on these two assets. So year is 2011 students. First asset is first plant is purchased on January 1st. Okay, so this plant is purchased for rupees 20,000 and depreciation given is 10%. So 10% of 20,000 is 2,000. And the next plant purchased on July 1st in the same year. So the plant cost is 8,000 its cost and 2,000 on its erection charges. So total 10,000 is paid for purchasing this plant. So 10%. So students, this plant is purchased for July 1st. So okay, so the depreciation is provided from July 1st July to 31st December. So 6 months are there. So we provide the depreciation for 6 months. Okay. So the amount of depreciation is 500. Okay, so now we provide the total depreciation for the year 2012 is 2,000 plus 500, 2,500 total depreciation we provided here. So in this, on the buy side we write the date and the last date and last month of the year 2011 and we write buy depreciation account 2,500. 2,000 on first machine, first plant and 500 on the second plant. Now we carry down the balance on the last date. Buy balance carry down. So first for carry down purpose we do the total. So the total of debit side is more than credit side. So 30,000 is total. Now we carry down the balance 27,500. Okay, so this balance is brought down in the next year. First of all, we write the year 2012, January 1st to balance brought down 27,500. So students, the asset which is purchased on January 1st 2011 was sold out in in this in 2012. Okay, so this asset is sold on 2012. So we calculated that how much amount is sold. So see, we prepare a working note to calculate the sale price, to calculate the profit or loss on this. Okay, so first of all, original cost of the asset is 20,000. Yes, so less the depreciation. So depreciation for 2011 is 2000. 2012 depreciation. So this machinery is purchased on 1st July. Okay, so machinery is sold on 1st July, but we provide the depreciation for the previous 6 months. So we provide the depreciation from 1st January to 30 June. So 6 months are there. So 6 months depreciation is 1,000. So the original cost is 20,000. As I told you earlier, that this plant was sold out on July. In the 2012, this plant was sold on July. Mean depreciation for first 6 months must be paid from January to 30 June. So from January to 30 June, depreciation 2,000 we calculate for 6 months. It is 1,000. So we deduct the depreciation from 20,000. We deduct 2,000 and total 3,000. So it is 17,000. Okay, 17,000. But this plant was sold out for 12,500. So see, loss is there. The price of the plant is 17,000, but is sold for 12,500. Mean loss is there. So how much the amount of loss? 4,500. So this is loss. I repeat it again. Working note. Okay, so original cost of the machinery which is purchased on January 1st 20,000. So we less the depreciation of the previous year 2011 is 2,000. But this machinery was sold on July 1st, means we provide the depreciation of previous 6 months from January to 30 June. We provide the depreciation. So 2,000 for whole year. We calculate for it 6 months. So it is 1,000. When we deduct these two depreciation from the cost of the asset remaining the value 17,000. The asset of 17,000 was sold for 12,500. So loss is there. So loss is 4,500. Okay, students. Now we add all these on the buy side. So first we write the year. We rate on which asset is sold out. So when asset is sold out, July 1st. Buy, when asset is sold out, the journal entry is cash account debit to plant account. So we write buy cash and we credited the plant account. So the asset is sold for 12,500. So we write 12,500 here. Now on July 1st depreciation is also paid. So we write here depreciation. We provide depreciation only on this asset. So depreciation is 1,000. After providing depreciation, this asset is sold by. So when this asset is sold, we also write the loss here by P&L account, profit and loss account. Why we recorded it debit side, credit side? Because it is loss. The amount of loss is 4,500 as we calculated in the working note. 4,500. Okay, so the entries related to the first asset, that is sold out, is done. Now the asset which is purchased on July 1st 2011, we provide the depreciation on this asset on the last month 31st December by depreciation. Depreciation we already calculated here, that depreciation is, so 10,000 depreciation is for 1,000. Okay, now we carry down the balance December 31st by balance carry down 4 by balance carry down 8,500. 27,500 total. From 27,500 we deduct all these amount and the balance we carried on is 8,500. Now we brought down this balance 2013 January 1st to balance brought down 8,500. So in this year on October month, on 1st October 2013, new plant is purchased. New plant is purchased. So plant account is debited by writing to cash account. The plant cost is 28,000. So in this year 2013, the plant cost 8,000 and erection charges 2,000, which is purchased on 1st July 2011, was sold out. Okay, so this plant is sold out. We also calculated the sale price. So we prepare a working note number 2. Okay, to calculate the value of the asset which is sold out and calculate the profit or loss. So first is machinery which is purchased on July 1st 2011. Cost price of this machinery is 10,000. Okay, depreciation provided. Depreciation for 2011 500. 2012 it is 1,000, and for 2013 depreciation is provided for 9 months from January 1st to 30th September, for 9 months, because October, on the month of October it is sold out. Okay, so depreciation is calculated 10,000 at 10 into 9 by 12, so it is 750. Okay, so the total amount of depreciation is 2,000. It is 2,250. When we deduct 2,250 from 10,000, the amount which is remaining 8,250. So out of 8, so this machinery was sold for 6,000. So the remaining amount is 1,750. So 1,750 is loss, because the value of asset which is remaining 8,250, but this is sold for 6,000. So 1,750 is loss here. So we record here. We write here first October 2013 year, October 1st by cash account. This machinery was sold for 6,000. Okay, after that we write October 1st by depreciation. Depreciation is provided for rupees 750, and loss is October 1st by P&L account. Loss is 1,750. Now we provide the depreciation on the another asset that we are purchased December 31st. The asset which is purchased at rupees 28,000. So depreciation is provided for October to December The depreciation is 700. So 28,000 into 10% into from October for 3 months. For 3 months depreciation is 700. Okay. So now we do the total of these two sides. So 28,000 debit side is 28,000 plus 8,500, it is 36,500. 36,500. Now we carry down the balance on the last month, the last date, by balance carry down 27,300. So as in the question given that we have to prepare a plant account for the year 2011 to 2013. So this is completed. Now we brought down the balance of 2014 and we end this and we close this account. On January 1st we brought down the balance 27,300 and we close this account. So clear, students? Purchase and sale of assets on different dates.